What's going on, Investomaniacs? Knight Rider here, and today we have an advanced investor tutorial for you. We're talking about the PEG ratio. By the way, if you're looking for one of my crazy, entertaining videos, this is not it. This is an advanced investor tutorial, so it's gonna be a lot of numbers, a lot of information, and not that much entertainment. Sorry, you can check out one of my other 90% of videos if that's what you're looking for. By the way, we're gonna be going over kind of the basics of the PEG ratio for the first minute or two, and then we're going to get into some of the more advanced concepts. So, what is a PEG ratio? A PEG ratio is a rough valuation estimate. The formula for a PEG ratio is as such: the PE divided by the earnings per share growth. So, for example, we have company A, which has a PE of 10. And let us remember, a PE is the price of the share divided by the earnings of the share, or earnings per share. So company A has a PE of 10 and an earnings per share growth of 10%. So PE is 10, we would plug in 10 here. Earnings per share growth is 10, we plug in 10 here. 10 divided by 10 is 1. So therefore we have a PEG ratio of 1. Company B has a PE of 20, so we would put that up top. And earnings per share growth is 25. We'd put that at the bottom, and 20 divided into 25 is 0.8. So company B has a PEG ratio of 0.8. Company C has a PE of 50 and an earnings per share growth of 30, and therefore has a PEG ratio of 1.67. The PEG ratio takes earnings per share growth into consideration and tells us that although company A has the lowest PE ratio, company B represents the best value due to it having the lowest PEG ratio. So again, we'll look. Company A has the lowest PE, so on the very basic level, this would be the cheapest valued stock. However, because we take growth into consideration, company B is the best value. Even though company C is growing faster, it costs too much on a PE basis with a PEG ratio of 1.67. So this would represent the worst investment, not taking any other information into consideration. That would conclude the beginner's version of what a PEG ratio is. Now we will get into some of the more advanced concepts. Scenario 1. Company A has a PEG ratio of, a PE ratio of 5 and an earnings per share growth rate of 5%. Technically, that's earnings per share growth rate percent 5. So 5 divided by 5 equals 1. Company A has a PEG ratio of 1. Company B has a PE of 50 and an earnings per share growth percentage rate of 50. 50 divided by 50 equals 1. Do one of these companies seem a better value than the other? Most investors would say no, because the PEG ratio is the same on both companies. So theoretically, they should represent the same investment opportunity. Since it is difficult to estimate exactly how the price of a publicly traded share will be affected by certain growth, we are going to run numbers in this tutorial as if this were a private company you owned 100% of. So that way, earnings, we can do hard math for that. There's no guesswork. Also, to avoid making things any more complicated than they already are, we will also not consider inflation, reinvestment opportunities, or future changes to growth. So you may have felt the investment opportunities were equal on company A and company B, or perhaps you preferred one over the other, but you probably did not grasp the reality of just how drastically different these two investment opportunities are. So, profit after 30 years, company A would be 1,395% profit. Company B would be a whopping 1,150,500% profit, meaning company B represents a value that is 824.7 times better if you are investing for a 30-year period. This leads us to, and let's go back and remember which one company B is. Company B is this one. Remember, they both have the same PEG ratio, except Company B has a PE ratio that is 10 times higher and an earnings per share growth rate that is 10 times higher. So even though the PEG ratio is the exact same, and we just multiply the PE and the earnings per share growth by 10 each, the outcome was dramatically different, right? 1,400% return versus 1,000,000% return after 30 years. This leads us to this mathematical truth. Given enough time, the faster growing company will always produce a superior return regardless of price. Here's scenario 2. Company X has a PE ratio of 20 and an earnings growth rate of 2%. Therefore, you take 2,000 divided by 2, you get a PEG ratio of 1,000. Company Y has a PE of 0.209. Obviously, that doesn't exist in the real world, but I'm trying to illustrate a point to you. So we take an amazingly crazy cheap stock, PE of 0.209, and it has an earnings growth rate of 1%. And it has a PEG ratio of 0.209. Now, Company X's PEG ratio, this one, is 4,785 times more expensive than Company Y's PEG ratio. Yet, after 1,000 years of investment, Company X has surpassed Company Y in returns. Company X would have 1,015,000,000% return, whereas Company Y would have a 1,013,000,000% return. So this would roughly be the break-even year after 1,000 years, where Company X would now be more profitable, a better investment than Company Y. If you're investing less than 1,000 years, which in the reality would be the situation, you would want to invest in Company Y. If you're investing for more than 1,000 years, you would want to invest in Company X. I am going to say this again. Given enough time, the faster growing company will always be the best investment. So why then don't we just invest in the fastest growing companies? Because in the real world, our investment horizon is finite. Most people will need money for their retirement in 20, 30, 40, 50 years. Everyone is going to die probably in less than 120 years. And company growth rates slow in the real world, and virtually all companies will eventually go out of business. Therefore, we must take time into consideration. For example, let's revisit scenario 1, but evaluate it based upon investment duration. Scenario 1B. Same numbers. Company A has a PE of 5, earnings per share growth rate of 5%, and a PEG of 1. Company B has a PE of 50, earnings per share growth rate of 50, and a PEG of 1. After 5 years, Company A would provide a 116% profit, and Company B would only provide a 39% profit. So again, this one would be the superior investment if your investment horizon is 5 years, and then at that point you want to say sell the company, get out of the stock, and you want to reinvest into something else. After 9 years, that's your break-even point. So remember at the last example, we had a break-even point of about 1,000 years where it went from one company being the best investment to the other company being the best investment. In this one, it's a 9-year break-even point. So Company A will give you about 231% profit after 9 years, whereas Company B will give you a 224% profit after 9 years. So if you want to invest for less less than 9 years, you would want company A. If you're investing for more than 9 years, you would want to invest in company B. See, just because the PEG ratio is the same doesn't mean that you should just go, oh, they're the same thing, or I'll go for the cheaper one. The duration of investment counts. And if you were to hold it for 20 years, company A would only give you a 694% profit, whereas company B would give you a 19,945% profit. So, now that you've learned some more about PEG ratios, when is a PEG ratio useful? A PEG ratio is useful as a rough and quick way to estimate valuation early on in your investment process. A PEG ratio should primarily be used for 1 to 10 year holding timeframes, as the ratio becomes less helpful as holding duration increases. A PEG ratio is also best used for well-established companies which have been profitable for several years. A PEG ratio is useful for companies which have similar earnings per share growth rates. For example, 5% and 8% or 12% and 6% earnings per share growth rates. When is a PEG ratio less useful? A PEG ratio should not be a significant factor in your final investment decision. Instead, you should perform manual calculations over the appropriate investment durations for a more clear picture. Remember, that's how long you want to be invested for. A PEG ratio is less useful for greater than 10-year holding timeframes, as current valuation becomes less important relative to future growth. A PEG ratio is less useful for high growth companies which are intentionally reinvesting nearly all profits back into the business to increase revenue growth. A PEG ratio becomes less useful as the earnings per share growth rates diverge. For example, 2% and 20% or 10% and 30% earnings per share growth rates should not be compared using a PEG ratio. These are dramatically different classes of investments. Remember, a 2% earnings per share growth company versus 20% earnings per share growth company. These are dramatically different classes of investments, and the faster growing companies will often have a much higher PEG ratio, misleading you to believe the slower growing companies are superior investments. Hope you guys enjoyed. If you have any questions, please leave a comment, and you guys have a great day.